Now we will see the same example using the temporal method. Well, temporal method is a little bit complicated, but we will see, and here the chart will be given, so you don't need to memorize anything. So now we will convert the same subsidiary located in Switzerland, Swissquote, using the temporal method. So first, here I just want to remind you some terminologies. Remember, for the temporal method, the subsidiary is using the US dollar. So the subsidiary is using US dollar. Still, we need to convert it into dollars. So the process is called remeasurement. And if you remember the chart for the temporal method, the gain or loss will appear on your income statement. Since the gain or loss we have to show on the income statement, we need to do a backward conversions. That means we will first convert the balance sheet, then we will convert the statement of retained earnings, then we'll convert the income statement, and to match the numbers, whatever difference, we will call it gain or loss. And our goal is to show the gain or loss on our income statement. So let's do the temporal method. This is also the reminder temporal methods, key items for liquid items or current items, especially on the balance sheet side, cash, receivables, and even liabilities, we use the current rate. But long-term items, especially plant, property, equipment, and inventory, we use the historical rates. And this is kind of matched with the historical cost principles in our US GAAP accounting. So again, after doing all conversions, we will show the remeasurement, gain or loss, and that will be on our income statement. So it's easy to do the balance sheet first. Let's convert the balance sheet. This is the same Swiss franc balance sheet. Now what we are doing, we are now converting following the column under the temporal methods. And if you remember, for current assets and liabilities, we use current rate, which is December 31st. For long-term assets and intangibles, we use historical rate. Historical rate means when we recorded those items, when we purchased those. So for plant, property, equipment, this is here March 15 is the historical rate. For patent, it's April 10. So we are using different rates based on their acquired or purchased or recorded dates. Those are the historical rates. Now for liabilities, we use the current rate, and common stock, additional paid-in capital. These are always the historical rates. Up to this, we followed the chart and we converted all those numbers. Now, again, the problem is that the dollar balance sheet will not be balanced. Swiss franc balance sheet is a balanced one, but when I'm multiplying a balanced balance sheet with different multipliers, right? The asset side, we are using different items into different exchange rates, same thing, liabilities and stockholders' equity. So here it will not result in a balanced balance sheet. After converting the assets part, you will see the US dollar assets is 1,744,800. But now if you do the liabilities and stockholders equity, here accounts payable, long-term debt, common stock, additional paid-in capital, up to that, it will not be equal to 1.7448 million. So to make the liabilities and total equity equal to total assets, we have to plug in the retained earnings. We are not calling it gain or loss because we'll show it on our income statement. Rather, we are plugging in the balance number, and we call it as retained earning. And this is how retained earning is a composite number. Retained earning is a composite number which we put it to balance the balance sheet. So to balance the balance sheet, retained earning becomes 309,800. Now it's a balanced balance sheet because we imposed or plugged in this retained earning number to make it balanced. It's a composite number. So please copy that number. The retained earning numbers in dollar value is 309,800. So this retained earning we will be using as the ending retained earning. We are doing backward conversions. We did balance sheet. Now we will do statement of retained earning. So this one is copied and pasted from the prior converted balance sheet composite retained earning. You see here 309,800. So we just copied and pasted it here. Now, dividend, we use the historical rate. Net income, here is net income is again a composite number. So just think of it, this is small algebra, right? So our ending retained earnings should be 309,800. How we get ending retained earning? We have something beginning retained earning, then we add net income, then we subtract dividend. Beginning retained earning is 0. We don't know net income, right? So what number we have to plug it in? So ending retained earning is nothing, it's after deduction of dividend. So we will add back dividend to show the net income number. So we subtract dividend to end up with retained earning. Retained earning, we got it as a composite, so we add back dividend to get the net income number. We can also adjust it if it's the second year, we have a retained earning, but it's the first year, beginning retained earning is 0, so we added back dividend to get the net income number. So net income is also a composite to balance the statement of retained earnings. So just see and remember this dollar net income, which is 470,300. We'll copy this dollar net income, we'll paste it on our dollar income statement. So now this is the income statement in Swiss franc. And temporal method is a little bit complicated because, like we are using different items and different exchange rates. We have the chart. We followed all those exchange rates and converted all the income statement items. Cost of goods sold is calculation. What does that mean? Because they have different bulk of inventories. So they purchased inventory or goods at different times. And based on that, we calculated the cost of goods sold. So this is how we calculated it. But say it's all given. Now you will see here after these sales dollars subtracting cost of goods, so you get the dollar gross profit. You subtracted all other expenses. You subtracted even income tax. But you will see after up to this, after subtracting income tax, this number is not matched with your net income number. So this is up to your converted income statement numbers in dollar, which is 517,300, but it does not match with those composite net income number we copied and pasted from our converted statement of retained earnings. So to balance these net income number to make it equal to our composite net income number, we have to plug in something here. And we have to plug in a negative number because our converted net income is actually higher than what is our composite net income. Composite net income is what we got based on the composite retained earnings. So since we have to subtract a number to reach with these converted net income numbers, we will call it a loss, remeasurement loss. So if you plug in a negative number to match it or balance this, it will be a loss. Some cases you may see you have to plug in a positive number on your income statement to match with that priorly composite net income number, then it will be a gain. In this example, it's a loss. So this is how we do the temporal method. So for concepts, you really need to know how we convert the different items for the financial statements. But for the exam, you don't need to do the whole things. Rather, I will ask only specific items from the income statement and balance sheet, and next class we'll practice that. So the last slide is talking about the comparison. Just because we are using different methods, we end up with different current assets, different total assets, different net income. Now, if you want to measure the performance of your subsidiary, usually we do some ratios, right? If you remember, current ratio, leverage or debt equity ratio, ROE, return on equity. So these ratios are based on some income statement and balance sheet numbers. Now, if you look at the converted numbers, if you use current rate, the first column is showing the converted dollar value using current rate method, and then converted dollar value using the temporal method, you see both are not equal. So you have a difference. And based on those numbers, if you calculate the ratios, you will end up with different ratios. For example, you will see here ROE. ROE is different, right? ROE is different. ROE under the current rate method, 54.7%. Under the temporal method, 58.1%. Same thing, current ratio different. So why we are saying this, that means that just because of different numbers, you may end up with different performance results. So we have to be careful when we have to assess the performance of the subsidiary or the parent company. Might be mindful about using the same methods if they have multiple subsidiaries, so that they can apply their judgments. So there are pros and cons, no fixed methods, but we may result with different performance based on the method.